The market just sent a loud signal. Silver has smashed through $46 mark. The dollar is lining up for a rebound, and Nasdaq is losing steam while the S&P 500 steps in. This isn't random noise, it's positioning at work, and the COT data is showing us where the real edge lies. So let's break down the setups from S&P 500 to the Euro odd, Bitcoin, and to the 2-year note, and map out how to trade Q4 opening moves. I'm Phil Moves, and if you're following my newsletter, staying sharp with COT data insight, this will bring it all together visually. Let's get into it. So we'll start with NQ this week, and NQ has played out fairly normal without any surprises. We had a relatively muted week on NQ. There are no surprises here. We already indicated last week that we didn't want to see more all-time highs being created and rather some digestion of all the euphoric price action that we've had following the FOMC 2 weeks ago. So this only means that the market cooled and we would remains to be seen if the market finds more breathing room higher. However, we think this is a good week for intraday moves rather than swing trading the indices. We have the non-farm payroll in point, we have JOLT, and we have ADP too as well. So this makes for a good intraday trading week. Now, how do we see positioning on NQ? On NQ, we can see 89,900. So they are still committed long. The short have been trimmed off a little bit, means they've taken profit from their short, which has played out nice for them. However, commercials have de-risked, right? So we had extreme positions last week following the FOMC decision. They've peeled back on all of that, and this is a fairly well hedged position by the non-commercials. And when we see both long commitment and short commitment, it's usually more tricky price action in terms of intraday moves, right? And this is why this week we actually want to focus more on the ES. And what do we see on ES? On the chart, it's fairly the same with what happened on NQ. No surprises here. But on the COT data, there's a big difference, right? What do we see here? We see that for the ES, there have been persistent short commitments by the non-commercials as compared to the longs. They've cooled off on their longs, no aggression here. Rather, they've been more pronounced on the short. When I say aggression, whenever you see this red bar, it means more aggression. Whenever you see the blue, it means cooling off. And we can see from the commercials here that they have also de-risked from the FOMC hedging program that they had all back. And overall, the percentage long and short remains bullish. And at the moment, we have peaked in net positioning following the FOMC. We are now in week 2. And during week 2, we try to find a counter positioning trade. So we are leaning more bearish intraday post Tuesday close. Again, post Tuesday close. Seeing that we are heading into the end of Q3, we expect Monday and Tuesday to be bullish to round up the Q3. And upon the opening of the new week, upon the opening of Q4, we should see short comes into play on an intraday basis. Okay, so that is what we see in the indices space. What else again? For the dollar, we can see a clear stark difference too as well. In the dollar, we can see a massive interest in long positioning by the commercials as compared to short position interest by the non-commercials. And we have been highlighting this for over 4 weeks now that the moment we climb back 20,000, we are interested in a bullish case for the dollar. And this is pretty much what we've got following the FOMC meeting and also the contract change. FOMC was on the 17th, but we had the contract rollover on the 12th, and all of this is clearly, it's been 2 weeks now for us to see the clear side where they are committed to, and this is to the longs. Until these longs are fully executed on the chart, there's no reason to be bearish the dollar in terms of like major swing, but for like intraday plays, of course, you can make arguments for that. However, we hold the case that in the next 3 more weeks, apparently, we would see some very nice swing opportunities again on the dollar. For now, we are now in week 2 after the peak in net positioning by the commercials. Not forgetting that we have also very high amount of short interest by the non-commercials, which makes for longs to be interesting. But when we look at the charts, we have to ask ourselves, how high have we been, and where's the next point of interest. If you ask me, I think this equal highs here have good interest to me. We want to see how they clear out these highs, and then we can begin to ask for some kind of cooling off on the positioning. So we want to see how these levels are taken out, and then we can begin to make arguments for rollover should we get catalyst. So should we get catalyst? So for now, we are looking forward to see how next week, Monday, Tuesday, and interest take out these equal highs here, and then Wednesday, Thursday, Friday, should we see a reason to roll over, given a disappointing ADP or given a disappointing non-farm payroll? It remains to be seen, and that remains something we are watching closely for. But we would like to see how Q3 ends bullish, which we are making the case for. I think it's going to close bullish, that's for sure now. Okay, what else again? Another thing of interest to has to do with the opening gap. We highlighted the importance of the opening gap. This was the 10th of September and into the 11th of September. This opening gap was the draw on liquidity that we kept seeing upon the FX majors, and this was simply what drew markets to fill up this gap. Now that this gap is filled, we just have to ask ourselves how is positioning placed, and we can see that that is mainly bullish the dollar, right? So, but we are entering into a week, not such as non-farm period, where we think intraday price action is usually one of the best place to be in. So we are waiting to see how the data comes out for those prints. Another thing again is to look at, okay, so let's take a look at other FX majors. How did they close the gaps that we were calling for on the dollar? The yen, we asked this gap to be filled. I remember we highlighted this last week in the last week video, and we wanted 2 weeks of weakness on the dollar. Monday, Tuesday, and Wednesday rolled over, filling up this gap completely because we missed it by some few points. We knew that was still going to be the draw. On the euro, again, all of this gap was filled completely, and that's so beautiful. We had no gap on GBP, but the weakness on GBP started on this Thursday, 18th of September, following the dovish hold by the Bank of England that we highlighted. That was disappointing to see. Now, the Swiss franc still has some room to play. We want to see that gap completely filled up, which is not the case right now. So, which means further bullishness on the dollar against the Swiss in the next 2 days, again, like Monday, Tuesday. Australian dollar, there was no gap. So, there was no gap for the New Zealand too as well. This was precipitated by a very bad GDP print on this Thursday here, and the rollover was just sweet to see. Canadian dollar, not fully into the Canadian dollar. However, we had a gap here, and this gap again had to be filled. That's literally the trade for the past 2 weeks on the FX pair. The gap was really the draw of liquidity, followed with the very strong GDP print we had on Thursday, 2.8%. Again, that cemented the path for the dollar. Now, what do we see going forward? I said that earlier. We want to see how these equal lows are being cleared off upon Tuesday close, meaning bullish Monday, Tuesday, Wednesday, Thursday, Friday, leaning more bearish. Should we get a confirmation from ADP and the non-farm payroll? On Thursday, we avoid trading towards the non-farm payroll week on the indices. Next is going to be for Bitcoin. For Bitcoin, we can see on positioning what we actually want to see on positioning here mainly is the open interest. We don't have any interest because this trade was mainly on the open interest, not necessarily the positioning of the commercials or the non-commercial, because we know they've been cooled off all this while, which was why we were positioned on altcoin from the 9th of September, calling for an outsized reaction in altcoins versus Bitcoin, which if we look at what we had during those week, we had on week one, we had fantastic soul out performance, 16%. Lo and behold, upon week three now, this was all flushed out, right? So we are back to nothing, zero. What happened is this. So we had a contract expiry on the 24th of September. That was actually a tell sign for rebalancing of the book. And that was why we have a flush out to clear out. I think I marked out these levels to out here as the likely drawn liquidity upon the close of this contract. However, seeing that the open interests were not up to 30,000 that we highlighted last week, I was like, okay, we can just still stay positioned. I had no anticipating of how bad the drawdown was actually going to be. And well, this is why you respect the risk by being on spot and not over leveraged, because majorly that's what the market did. With this sharp reversal that happened both on Monday and on Thursday, most leverage traders were actually taken out. So For now, we still remain positioned on altcoin, pending when the open interest gets back to its average seasonal average of 30,000. So it's going to continue to be a range bound situation where we're taking the lows going like take for example the Bitcoin has been a range bound ever since this peak here. So come lower, higher again. So basically we're in a range bound on Bitcoin. But upon this contract expiring now, we want to see how they are positioned into this new contract. We don't have a glimpse into that just yet until next week Friday, and the before the data even comes out, I'm sure upon Tuesday close, we will see evidence for either upside continuation or downside continuation, and that should pretty inform us before the next CFTC data comes out. So that's what we are watching out for Bitcoin. Upon Tuesday close, we want to see sign of bullishness, or else there'll be a problem. And also, the data from CFTC is going to also inform us to ahead. Euro GBP is also an interesting pair for us to pay attention to, not based on price action. We called for a range bound last week, and that's what we got on price action. Not based on price action, but rather based on positioning. So we've seen two consecutive weeks of extreme commitment to the short side by the commercials, whereby the non-commercials have cooled off on their short, they've cooled off on their long. And what happened? We have an increase in the net positioning. As far as we continue to increase the net short positioning, this is actually bullish, the Euro GBP. But whenever we peak, we expect the opposite thing to happen, meaning the more net positive they become in their net positioning, the more bearish it's going to be for Euro GBP down the line. And that's something we want to keep on watching for observation. But for the week ahead of us, the most important thing is this is bullish the Euro as the favored pair against the GBP, and we want to see how that plays out. So we take a look at the economic calendar. We are not talking about the GBP. We're talking about Europe being favored against the dollar, no, against other FX pairs. So think about the pound, the Aussie, the Kiwi. Next week, we just have to look at the calendar. Where do we see any interest? And this is for China. We see that there's a very high impact news for the Aussie, where we have the cash rate being determined by the Reserve Bank of Australia. And apart from that, no other red folder news. So we think the inflow is going to be with the Australian dollar. If that be the case, we have to be able to ascertain if it's going to be a hawkish hold or a dovish hold. We are rooting for a dovish hold to weakened odd against the euro dollar, and that should give us interest to take out this equal highs here and this levels highs here too. So that would be a good swing should we get a confirmation from the rate decision next week Tuesday. So upon the Tuesday close, it's going to work out. Do well to check out this article. I have this article here I found on Forex Factory that's very interesting. It's basically highlights a very good recap on the rate part for the Aussie, and I liked it actually when I read through it. So that should inform, that should give a good picture of what's up for the Aussie against the Euro GBP. For silver, silver has been an interesting play. We called for entries upon the Friday, this Friday here, the 19th of September. We took profit somewhere here on that Monday, Tuesday. I was considering the possibility of a range bound, and you can see that was what happened in gold upon the close of Monday. So I took profit there, but I didn't anticipate that Thursday and Friday was going to be even more outside. That happened. We were calling for 44.5, but instead we got as high as 46, and it's just fantastic to see how the commodities are just on fire. And yeah, this concludes our trade on silver. This concludes it actually doubled the price action we were looking for on silver, and we kissed silver goodbye. So for gold, what do we think is going to be the play? It's still going to be bullish, but how high can it get? I really can't tell. Unless the dollar weakens upon Tuesday close, then you can find an argument for gold. But for now, it's just there, not an interest for us. Lastly, we have to go into the 2-year bond notes. This is very, very important to inform our outlook on what we think the dollar is going to do next week, moving forward. And the most important thing here is this gap. Upon the contract rollover in the FX major on the 12th of September, we began to call that as far as those gap in the FX majors, they are going to be a draw on liquidity, and that draw is going to likely facilitate bullishness in the dollar. Now, this continues to be the case. We want to see this gap completely filled up, and as that continues to be the case, this is bullish the dollar. Now, when it bottoms out upon Tuesday close, and we begin to see sign of bullishness here in the T note, that will be bearish the dollar in the short term, of course. So it remains to be something we want to watch and see. This was also the case back in June. So back in June, what happened here? We had this gap being filled up upon that Tuesday close here. The next day, swept all this low and then closed bullishly. We knew for sure that this was going to be a bearish scenario for the dollar. And if you check, that was actually the case until we picked out here, right? That aside, anyways. So that's what we're also thinking about too here. Fill up this gap, find some support, and upon finding support, that should be bearish the dollar in the short term. This does not change our general outlook on bullishness on the dollar, just a short term play, pending when the real move comes into play. So that's our call on the 2 year note on how it influences our outlook on the dollar. The rules remains the same for the rules remains the same next week as NFP. Monday to Wednesday you can intraday trade, Thursday skip, Friday wait until after NFP. I have to highlight a trade here, which is going to be the euro odd, which is our conclusion about what is to come for the euro being the favored pair. Now, for the euro odd, what we see here most importantly is the fact that we have a shift in market structure somewhere here. Yep, we have a shift. We have a shift in market structure, and we have a rate decision coming up for the Australian dollar. If the Australian dollar have a dovish hold again, that should support the euro higher against the dollar. So it's a clean trade if we get that catalyst from the bank, which remains to be seen. And we think 1.81 is not a bad, it's not a bad target actually. 1.8 is not a bad target. So this remains to be seen, and we'll watch to see how that plays out over the coming days and weeks, perhaps 2 weeks max. All right, that's it for this week's COT Outlook. If you found this helpful, like and subscribe, and drop a comment if you're watching any of these setups too. If you want to dive deeper, the full write-up is in my Substack, link in the description. Stay nimble, stay sharp. See you next week.